Welcome to our High Rock monthly video. I'm Scott Tomlinson, and with me today is my colleague and partner and the founder of High Rock, Paul Tepsich, as well as High Rock certified financial planning professional, Bianca Tomlinson. Do apologize for being a little tardy this month. As you may know, I was away at the beginning of February, but back in my saddle again. Well, January was a volatile month for stocks, but our portfolios were beneficiaries of our defensive posture. And speaking of our portfolios, let's talk a little bit about our positioning. But first, let's talk about our mandates to you, our clients. When Paul and I first started our private client division, it was, as we say often, intended to create an environment where we manage risk to protect our capital first and foremost and get appropriate growth within the context of our long-term goals, which are driven by our respective and custom wealth forecasts. Our private client division was intended to have like-minded investors participate in the same assets as we did, but in varying allocations consistent with their goals as determined by their wealth forecast. In recent conversations with some clients, there has been some discussion around our conservative style in light of a rapidly rising equity market. Now, some clients would like to have a greater participation in it, despite the rising levels of risk. Other clients we talk to actually want to reduce their exposure to equity markets with rising risk. So everybody has a different perspective. And we want to make sure that that we're accommodating our clients accordingly. And Paul and I have a more conservative approach. We don't want extra risk in our portfolios at this point in time, but we want our clients to know that they're absolutely welcome to adjust the risk parameters at any time. If you wish to make a more aggressive approach than that which we are taking for the majority of our clients and ourselves, that's very much a conversation that we encourage you to have with us. From the outset of your wealth forecast, we structured a strategy that we believed would get you to your goals while maintaining a risk level that we felt was consistent with long-term growth around a specific annual average target over a multiple year period. Life is dynamic. Things change, people change their goals and appetite for risk, and that is natural. So this is a discussion you should have with us. Over a year ago, we had a client decide that they wanted to go to all cash. They became afraid of the financial markets, and that's their decision and their choice. The point is that we are wide open to making adjustments for you if you desire a different approach than the one that we are taking. So just please let us know. So on the screen now we see is my portfolio. In red at the top are my target ranges for each of our three models. Now at the bottom, circled in red, are the actual portfolio allocations. So you can see that I am at the lower end of both my global equity and tactical targets. Now that is within my current comfort zone, but it may not be in some of our clients' comfort zones, especially if they wish to be more aggressive. So that, again, is a discussion that you should have with us. And don't wait. If you want to have that discussion now, please feel free to get in touch. My performance in 2018, I think I dodged a bullet, limiting my downside, but in 2019, I did not get close to some of the benchmarks. In 2020, I'm off to a great start despite a defensive posture. So I'm comfortable with that. However, other clients may not be as comfortable. So again, I ask you to please get in touch with us if you want to have this conversation about performance. Well, this is not my wealth forecast. I wish I could be that young, but this net worth is actually slightly ahead of target. So the question I would ask is, why change strategies? You can if you wish, of course, but why take on more risk than necessary if you do not have to? But again, that is always, as our clients, that is your choice. Okay, Paul, I should go back. Is there anything that you want to talk about as far as the actual portfolio itself and the composition? I noticed that there's been some adjustments to the duration of our short government bonds. Now we have 0 under 2 years, and I know that you've moved out to 2 years. Anything, and as well, I see that my tactical portfolio has is slightly smaller than it was at the end of 2019. Any conversations you want to have around that?
Yeah, maybe I'll go through slides 5 and 6. So fixed income in the model there, you're right. We had some shorter bonds we bought over a year ago, both in Canada and the U.S., and we kind of rode them down the curve, if you will, until they pretty much matured. One's maturing next month and one was maturing in May. So we sold those. We had the money temporarily in an overnight high interest savings account, which quite frankly pay us a bit more. So the question would be, why do we even want to own short bonds or any government bonds, given that they yield very little? And that's probably a longer discussion and answer for me to give, other than the fact I could say, government bonds last year, 10-year government bonds in Canada and the U.S. returned about 9% total return. So not bad. And over the last 2 and a bit years, I think 30-year U.S. Treasury bonds returned about 30%. So they can be very significant, and they are the best, most elegant hedge for a overall portfolio hedge that I can think of. So going out and buying option strategies like puts actually cost you money. So being long government bonds provides us with a natural hedge to our portfolio, and it actually pays us. It may not pay us a lot on a running yield basis, but it actually pays us. So the changes that we've made over the past few weeks are we bought a Government of Canada 2-year bond. And we bought a decent size weight, around 4 or 5% for most clients. That will have very little price volatility in it, but provides us with some sense of insurance if the world does blow up. And it's super liquid, obviously. The other thing we did do, well, a couple things. We bought U.S. 30-year Treasury bonds a few weeks ago in earlier mid-January. So we've kind of rounded out our duration in longer bonds. We didn't add any investment grade. We added, well, actually not in that bucket, but we added a high yield bond I'll talk about in a minute. Preferred shares, we've just rounded out a couple that we've had, both Great-West Life and Sun Life just today, should go in for tonight. In the tactical model, yes, we are a little bit below our target, which is a matter of valuation for the most part. We did add a high yield bond in our tactical model. Now, these high yield bonds in our tactical model we consider to be equity risk. So we're being ultra conservative on that risk measurement. We added Auto Canada, which is a nationwide pile of auto dealerships. That bond was yielding 9%. It came new issue. We were able to get some, but not nearly enough. And then they popped up 3% right out of the gate. So we probably won't add to that unless we see a major market sell-off. And the other couple things we've got going in the tactical model that are interesting. Number one is our largest single stock position is Yellow Media stock. I would say it's a company I know quite well. This stock has doubled over the past year or so. It's up now at around $11.30. We do have an order out to sell about a third of what we own to take profits at $11.70. I do think it can go a little bit higher, but we don't want to get too greedy, and we want to rebalance our position a bit, because for some clients it's getting kind of large now that it's doubled. So that's been a really good story, and I think it will continue. And the reason why I think so is the company has cut so many expenses out of this business that their free cash flow has increased substantially, and they will be net cash positive by the end of this year, which I'll talk about in 1 second as well. And they will either do share buybacks or institute maybe a special dividend or an ongoing dividend. So very positive story on Yellow Media stock. Yellow Media bond we own as well, which is should be our biggest position in the tactical model, or a single position in the portfolio. And similar thing, this bond is callable May 21st, might be May 31st, 2021 anyway. So just over a year away, this bond will be called by the company, which means they will take cash from cash flow and retire the bond. In the meantime, I was able to buy some in December at a yield of 7%, 7.03, I believe, a cash yield to that call date. So extremely low risk trade to pick up 7%. So that's the type of trades that we always look for and try to put on as a really strong position for us, and we do have that on. And if it gets a whole bunch higher, I might actually even sell some, because now it's trading, there's a potential of it's trading around 3.5% yield, in which case I'd sell it and we could replace it with a 5-6% type yield. A couple other things to note, Scott, or really just one more. Another high yield bond in the tactical model that came out with good news just 3 weeks ago or so is Crew Energy. So we hold this bond as well. They sold some they're a natural gas producer in the Montney, and there are very specific reasons why we own them. But some of the reason why came to fruition just partially in mid-January, where they sold some midstream assets, and the cash proceeds will pay down the bank debt, which is ahead of us in the capital structure, leaving us to be by the end of this year, when they have full proceeds in, we will be the top of the capital structure. And this bond yields around 9% to us. So it was good positive news. The bonds seem to be catching a bit of a bid right now, so moving a little bit higher in price. And they have ample upside. And the ultimate upside would be roughly a 40% return from here if the company is taken private or taken out by a competitor. So those are some of the highlights, both in fixed income and in the tactical model, Scott.
Excellent. Thanks, Paul. So what's keeping us up at night?
Besides my dog snoring. Yeah. Well, obviously this coronavirus, but as we probably all know, following the markets, that it's largely seems to have been dismissed by risk assets. Nonetheless, I think we do need to keep our eye on this one for sure. It seemed like a black swan event 3 weeks ago, and market ignored it. But we need to watch this for sure.
Yeah, and certainly, even though infections are apparently slowing, the economic ramifications of China basically shutting down is going to be felt. The reverberations are going to be felt globally, so we'll have to keep an eye on it for sure.
Yeah, I mean, supply chains could be massively disrupted.
Something we brought to people's attention was the New York Federal Reserve's recession indicator hitting 80 last August. Well, it came to light today that recession risk model is back up again. Any comment there?
Yeah, and that's largely based on the shape of the yield curve. But the bullet point number 2, it's never happened where we haven't hit 80% and been in recession in the next 12 months. So it's just, it could be different this time, but it's something we need to keep in mind and respect. Respect the history, because you know what? Nobody thought that in 2000. Nobody thought it in 2007. So we'll just respect it for now. Yeah, PEs. You tell me. What I think the forward PE is. Pardon me. The trailing PE is up around 25, Scott.
Yeah, it certainly is, and it's hard to talk about trailing because it doesn't give us an indication of what's to come. But at a record forward 12-month PE with continued lowering of earnings expectations, it just makes stocks even more expensive. Um, Again, things that we think are being ignored by current pricing in stock markets.
Well, so one thing I would add on that fourth bullet on PE ratios too, and I think we wrote about it in our year-end comment, is why the ratio is at its all-time record high is quite frankly because the market is bidding up the price of stocks, and the analyst community continues to move their targets higher just to track the price of movement in stocks. And the real reason is it's just called multiple expansion. So an equity analyst at a big Wall Street firm can put his thumb in the air and go, okay, well, now I'll put a 20 times multiple on it. Then I'll put a 25 times multiple on it. And that's where we are. So it's really nothing more than multiple expansion. And if we look, and maybe we will next month, and we did, I believe, Scott, in our year-end commentary, but if you look at earnings since 2012, they've been pretty stagnant, which, that's the fundamental reason you're buying a stock is for the future value of cash flows, and you can work out a discounted cash flow model, 5 to 10 years out and figure out what a stock is worth today.
Well, and the other thing to look at too is if last year we had basically 2% economic growth and yet flat earnings, how can we have earnings growth again this year if growth stays somewhere around the 2% level? I mean, there's math that just doesn't seem to work at times, and again, it's just things that make us concerned about current pricing.
And credit, as you mentioned here in the fifth bullet, corporate debt to GDP is kind of stretched as well. And interestingly, a lot of those are from large investment grade issuers, like Apple, for instance, who have sold up until I think 2 years ago. Apple had no debt outstanding, and then they started issuing investment grade corporate bonds, and they would use the proceeds to buy back stock. So they are effectively levering up their balance sheet because they had the room to do so. But they're not the only one, and obviously they're sitting on big piles of cash. It's the ones who are more at the margin, and some of these investment grade issuers are now, have credit metrics or leverage metrics that are higher than some high yield issuers. So therein lies a problem. Yeah, this is kind of interesting. I was just saying this to my wife last weekend that Warren Buffett was up around 11% last year in a 100% equity portfolio, but he had he was sitting on a huge chunk of cash at around 128 billion. So versus 24 billion 2 years ago. So that was that was a very conservative position for him. And the question you have to ask yourself is why is he sitting on, and then why has he grown his cash position by fivefold over the past couple of years? And it's probably not because he thinks the market is cheap, although he tells retail investors to go be long all the time and just jump in with both feet. It is interesting that he himself is building cash. It'll be interesting to see, Scott, what Berkshire goes out and buys.
And back home, obviously, we have to consider the Canadian economy, but we continue to see reasonably good numbers along the labor front. Certainly, the last couple of months of data have been positive, but wages aren't growing, and that's becoming a problem for Canadian households. And certainly, as we can see here with the consumer insolvencies rising to the second highest total on record, it is going to be a concern for the Bank of Canada.
Yeah, and one thing I would add on that last bullet, Scott, is we may have mentioned it before in another commentary, but when the Canadian banks, whose fiscal year end is October 31st, they reported in November their year-end results. Their fiscal fourth quarter ending October 31st, 2019, most of them, and a couple like CIBC, reported much larger than anticipated or expected PCLs, which are provision for credit losses. And that's right in this bucket here as well. So that's something that certainly I'm watching. When the Canadian banks report again, I think we need to watch that provision for credit loss number again. And that's part of the reason why our Canadian banks have not really participated much in this rally at all. There is definitely some concern amongst some institutional investors about these provision for credit losses, so we will watch.
All right. So what do we like? What makes us excited?
Well, low interest rates obviously make global risk assets exciting, and as we saw a couple weeks ago with this coronavirus, the People's Bank of China and the Federal Reserve both injected liquidity to ensure that the markets would maintain their froth, and that seems to have happened. But I think one thing we can always be excited about is nothing goes straight up. We will have opportunities to buy when the market gets a little fearful, not when it's greedy. And we ended last year, as you can see on this chart, and this is a CNN 7-factor model on fear and greed, and it's actually a pretty robust model. But we ended the year at damn close to 100% extreme fear or greed, pardon me, at the top, and I think we'll get opportunities back down, below 40 into the 20s and 30s over the course of the year, and those will be opportunities to start layering in some global risk.
Yeah, I agree, and then we are always watching for opportunities, right?
Yep.
All right. Well, that's it for this month. Thank you all for taking the time to tune in. We appreciate that. Again, if you have anything in regard to your specific portfolio or your wealth forecast that you need to talk to us about, we are always available and happy to have those conversations and discussions. So until then, and on behalf of Paul and Bianca, I'd like to say again, thank you for being here, and we shall be back next month at the beginning with another review.